Good morning, Size Traders. This is Amos here with Gary, head trader at SizeTrade. Gary, thanks for being here with us today.
Hey Amos, how's it going?
Good, good. Gary, we got a lot of interest last week about your option strategy that you discussed. Particularly, you were buying out of the money calls, and I know you did really well on them. So, first, since most of our guys are trading futures, I wanted to ask you to just quickly go over options, and then maybe we can go a little bit more into the specifics regarding your strategy.
Sure, no problem. Yeah, I saw some of those emails. I'm glad to see some of our traders. I bought some options. I don't know if they're members or just listeners to the podcast, but I saw some emails saying that they did really well without the money calls, and I'm glad to hear that options are a derivative of the underlining. So in this case, the underlining is ES. So we were buying options on the S&P 500 futures. Now, when trading options, you have to understand that it's not just being right about the price movement, it's also being right in the time frame. So if you remember when we spoke last week, I had a lot of Wednesday calls that I basically broke even on, and then I was able to roll over a lot of them into the Friday calls. Now, it wasn't necessarily that I was wrong on the direction. The market never went down. It was that the timing took a little longer than I expected. And that's part of trading options, and you have to quite understand that. That's why I like to take off my premium whenever I'm up in it. So on Wednesday, actually, I think I had $6,000 worth of premium that was expiring on Wednesday. So when I was up that much money in the morning on the open, the market actually was trading in the money at 22.85 off $5,000 worth of premium and let the rest of it go. It wasn't necessarily that I was didn't feel comfortable with the direction that I had the calls on. It just the timing is hard, especially the day of the expiration. So bringing that kind of all back to options. So options are priced basically on two facts. There's more, but the majority of the pricing on the options are based on two facts. The first one is implied volatility, which basically is a fancy way of saying where do traders think that the market is going to move, the percentage that the market is going to move. So when we're more volatile and the VIX, which is the volatility index, is higher, then the implied vol is higher, and thus the price, the premium that you pay for your calls and puts goes up because the market, the traders out there are looking for a bigger move. So they are they're pricing that in. So they don't want to give that up for free. So they're pricing it in and making you pay extra for it. The second part of the call or put, the second part of the option price is how close you are to being in the money. So the closer you are to being in the money, the higher priced the option is because people are you have to pay for the privilege of having limited downside risk. The reason why I like to work with the out of the money calls like I did last week is if I do, especially when the volatility is so low, so the implied vol is low, you can get really cheap calls and get paid on something that's you see in the S&P 500 a lot, a 0.5% to a 1% move. Now, a lot of the questions that I also saw from last week were why didn't I get some of the more longer dated call options? Well, the reason why is because the VIX is at an all-time low here, or near historical lows. So it's better to buy short-term options because that implied vol is already kind of degraded. That time decay they call it. Time decay has degraded, so you can get in very cheaply. And when you do get a 1% move in your direction, you can get paid. Like last week on some of my calls, I made 1,000% on them for the ones that expired Friday with the big move on Friday. They were relatively cheap. Like I say, I look to buy the calls or the puts that are around 20 cents, 30 cents to up to a dollar 10, maybe $1.20 maximum.
So Gary, let
So
me just
ba- so
let
base
let me just interrupt you for a second and just ask a question. As far as when a trader would look to trade the option rather than the underlining, it's when the VIX is low, when there's low volatility.
so there's a couple of times when you would want to trade an option versus the underlining. The first time is when the volatility is low. So basically what's happening in the market is it's going sideways. So there's a lot of strategies and some of our strategies are not working and that's fine. That's perfectly normal. There's the old saying on Wall Street, bulls and bears make money, pigs get slaughtered. So when the market is actually moving, there's opportunity and we make money and that's great. The problem is that a lot of times when the market is sideways, a lot of traders don't aren't able to realize that. The hardest part of trading is sitting on your hands, a lot of traders say. So they continuously trade the way that they expect them to trade and be profitable, but the market is just not giving them the opportunity, and they get chopped up and lose money a little bit every day. Sometimes it's more than a little bit every day. So part of it is when you have a low vol uh, time frame like we do now, where the market is stuck in a range, there's different ways that you have to look for other options to trade. One of the ways that I like to trade is I like to trade them with calls and puts, depending on which way I think that the market will go, because the low vol is attractive because the premiums are lower. So that's the first reason why somebody would trade options. The second reason is if you're not 100% certain in your technical pattern or indicator or whatever it is at the moment, it's a cheaper way to play them because you have limited downside risk. So in this case, and I spoke about this on multiple occasions, I saw the bull flag. I wasn't necessarily crazy about the bull flag. It wasn't like the best looking bull flag of all time. So based on that and based on some other things that I spoke about, some caveats such as, we're entering the weakest part of this bullish season in February. We had a doji, we had some reversal candles and so on. I felt it was prudent to take take the risk because you want to get paid if your pattern plays out, but in the most efficient way. And
So
I took advantage of the low vol opportunity to buy really cheap calls.
So Gary, let me ask you a question. At the risk of some of our listeners tuning out because we get a little bit more mathematical and with some more numbers, but what are you going to do? Trading's math, and that's how we trade. Could you give us some specific examples as far as the risk is concerned of why you went with options and how it would have panned out if you were trading futures? Meaning, let's look for a second at what you are how you entered in with the options, what you were risking, and why you wouldn't have traded the futures because the risk would have been XYZ?
Right. So yeah, I mean, it's hard to say because you don't know exactly where you would have put your stop, where you would have gotten in. But just as a simple example, if you were buying the ES in the 2280s, which was the breakout level, without waiting for the retest of the or confirmation, like I spoke about last week. So you were buying the ES at 2280s. The low, I believe, in the ES during last week's low was in the low 2260s, maybe mid 2263, 2264 on the ES. So you would have to take around between 15 and 20 points, depending where you get in, of pain. So depending where your stop is, you could have potentially got stopped out, been right on the direction, got stopped out, potentially even shorted if you thought it was a real breakdown. And that's when I talk about the choppiness is that you see the bull flag, we start breaking out of the bull flag, you jump in because the technicals and all the stuff that you read is telling you we're going higher, your gut's telling you we're going higher, whatever the reason is you trade, and gut is not a good reason to trade, but you get long at 2280s on the breakout. It goes into the mid to high 2280s. So if you're looking for like just a small bounce, fine, you got out. But if you're looking for a small bounce, you should also be looking for having a small stop. So in that case, you might have even got stopped out because I don't know if it just exploded higher. I don't remember.
So,
But the
so,
point
ulti-
is that
so ultimately, basically, you weren't confident that the pattern was going to play out. You weren't confident in the technicals, and so you preferred to do the option rather than the futures.
I step back and I take a look at the overall scenario. Every time you do a trade, you have to see the best way to set up the trade. It's actually one of the things that I'll go into a little bit later, but there's always different ways to play a certain outcome. So, just to give you an example, just because you have a bull breakout doesn't necessarily want to mean in the ES, doesn't mean necessarily you want to trade the ES if you've seen correlations that you think are lower risk. So a lot of times, instead of playing the ES outright, in this case I did play it because there wasn't so much correlation, but there was a lot of correlation with oil going down and the markets going down. So last year, so I looked into it, and if I saw the opportunity to short oil, but oil was risky because it was super volatile after dropping 80% from the highs, I would just play that via shorting ES because ES was following the oil markets, and I felt that even if oil bounced a few dollars, the ES percentage-wise would bounce a little bit less because there was other negatives in the beginning of last year from China and so on that would have pressure on the ES. So there's always um, correlations between assets, and you always have to try to find the best way with the lowest risk to trade your correlation. And sometimes it doesn't work out. There's always cases where, I think the ES going higher, but I think that will impact the dollar in a certain way, and I get long the dollar, short the dollar instead, and it doesn't work out. Yes, but majority of times so there's always different ways to trade what you expect the outcome to be. So that brings me back to the options. And sometimes I look at the options, especially when the implied vol is so low, when the volatility is so low, because I know I could get really cheap calls or puts that are expiring this week or next week or so on. So when I see a pattern, I have to play the pattern because that's the way you have to do it. If you believe in patterns, if you believe in technical analysis, you have to always trade it, even if your gut is telling you that it's not a uh, perfect setup. You just have to figure out how to put the risk to minimize the risk in your favor. So, see, in this case, with no implied vol, I jumped on it and took advantage of that. If the vol was high, I might have figured out a different way to play it, maybe using other asset classes like treasuries or gold that I would have seen some type of correlation. So I would have said to myself, hey, if the market goes higher, I think it's going to drag yields XYZ, lower, higher, and so on. Or it'll drag gold higher because, that means inflation is more prevalent. And I think that even if I'm wrong and the market comes in, gold will have a bit under it because I think people are pricing in inflation regardless. So, and I'm not saying this was the right way to play last week. I'm just trying to show you an example of how sometimes you could correlate different asset classes but take the least amount of risk. In this case, I decided that options with a low implied vol is the best way to play it. And I did really well with them. I did much better and I had a lot less stress and risk than just buying ES directly. ES, I was buying the ES in the calls in the low 2270s to the mid 2260s on the retest of the bull flag. That's where I got the majority of my calls. And some of them, like I said, on last Wednesday, expired worthless. But since the market opened at 2285, the 930 US Open, I was able to get off, I don't know, 20% of my position at a nice enough profit to break even for all of the premiums, and then the rest of the premiums expired worthless. So I broke even. I think I lost a little on commissions, but I was able to take that money, that 4 or 5 thousand that I got back in premiums, and I was able to put it into the Friday calls, and I did that. I didn't do that as much on Wednesday because I was waiting for the close, but I did that Thursday morning, Thursday afternoon, into Thursday evening. I was able to put that 4,000 plus I added a little bit more. I ended up having around $30,000 worth of premium expiring on Friday, and I had some 2300s that ended up expiring out of the money. 2295s, I actually made a ton of money, even though they expired out of the money. I did really well on those because I was buying them between 10 and 30 cents. Because when the market was trading at, if I'm not mistaken, 2275, between 2275 and 2280 in the morning on Friday or the night after the reopen on Thursday night. I saw that it's only a 15-point move on the yes or a 20-point move on the yes, someplace in that vicinity, to get in the money, and it was only less than a 1% move because a 1% move on the 3 points on the yes. I was still expecting a bullish outcome. We had the employment job number Friday morning, so I was able to buy a lot of contracts for very cheap, between 15 and 25 cents. So let's call it an average of 20 cents. And then when the market was between 22.90 and 22.95. A lot of those calls were trading at $2. So I started slowly selling that at $2. The 22.85s, which I had a lot of, were in the money around 5 or 6 points when the ES was trading 22.60. So I took those off for 6 points. I got involved in those around an average price, I think was 70 cents. So I made a little bit less than 10 to 1 on those. So it was a pretty decent day. Again, they could have expired totally worthless and I would have taken a hit. But I think it would have been to me a lot riskier to just buy ES in the normal size that I do and just basically wait for a move. And the move never really occurred. I mean, we're still trading 22.90 here.
So let me ask you, Gary. We always talk about probabilities of being right on some sort of trade. So, for instance, when we talk about our Eagle strategy, we have a historical data that we're between 60 to 70% right on our strategy. Here, when you took these trades, when you took these options trades, what did you feel? I mean, you had some sort of idea of maybe what the job report would be, but there was no guarantee. There's no ever any guarantee on anything really in trading. So what did you feel like your probability was of being right on these trades?
Um, it's difficult to say because again, it's not just about direction; it's also about timing. So I can say that based on the bull flag, I felt confident. I don't know, 70% chance, something in that scenario. I don't remember exactly when I looked at my models, but that we would go higher. I think it was like 72% chance or 67. I don't remember exactly that we would end up making a move towards 2300 on the ES. Now with the options, there is that caveat that you have to do it in a certain amount of time. So I don't have a probability on that, but what I do have is that I look to make between 5 and 10 to 1 on options. Typically looking to make, again, the day of execution, I just, if I get, 7 to 1, it looks like it's topping out, I'll take it. Let's say my average out is 7 to 1. Let's use that. So again, the chances of you having to be right is so small for you to make money or break even. So at 10 to 1, that means you have to be right 10% of the time. So if you're right
Right.
10% of the time, so out of, you break even. That's your break even. So when I trade options, I look more at what my break even point is, and I ask myself, do I think that I have a higher probability than a 10 to 20% chance of this move happening this week?
Perfect.
And
Right.
if I
That's
don't,
exactly.
I try to set
I
it up in a
I think that's the type of information that is really helpful for traders because we always talk about basically trading with some sort of mathematical model and having an idea of what your risk reward ratio is. And I think that's pretty clear that if you're trading, if you're looking to make 10 to 1 and you only have to be 10 or 20% right on your strategy, then it's a pretty good bet.
right, right. So again, it comes down to understanding the time frame of the market. So it comes down to understanding, hey, what's going on in the market. Not every strategy will work 100% of the time, and pushing the strategy and trying to make your strategy work in a time when the market is not conducive to that, when typically, the market is choppy, false breakouts, you're only going to get a lot of personal messages that I got where, hey, my personal trading is not going great because I'm getting chopped up. Is there anything you can help me with? And I usually tell these people that, it's not necessarily the strategy's fault. It's not necessarily that you're doing something wrong. It's just you have to understand that right now we're going sideways and you're better off sitting on your hands. And I know it's painful for a trader. Trust me, I feel it. I mean, it's one of the things that took me the longest time to understand. But sitting on your hands is sometimes the best trade you can do in a certain time. So that this is a more advanced or complex theory of that, because just because you're sitting on the sidelines on your strategy doesn't mean there's not other opportunities in the markets.
Right.
And
I think
you
that's
always
something
have
else we've talked about before that you build some sort of strategy and it's to work. It's that strategy could be built for 80 to 90% of the time when the market is has some sort of direction or is doing something. There's some sort of volatility, whatever it is. But then there's another 10 to 20% of the time where that strategy is simply not going to work because it wasn't built for that.
exactly, exactly. I mean, that's where this bull. I mean, we keep bringing it up. Bulls and bears, make money. Pigs get slaughtered. Is because you can't be greedy. I mean, greed is what kills um, a trader's P&L. Because if you have a good 10 months and 2 months out of the year, your strategy is not going to work. Not because your strategy is bad, but because the market's not moving enough, or the market's moving in a sideways direction, chopping everybody up. If you push yourself in those 2 months, you can give back 5 or 6 months of profits. So then at the end of the year, you end up with 4 months of profits, as opposed to ending up with 10 months of profit because you tried to push yourself for the extra 2 months. So you have to really understand how your strategy is set up, and if the environment's not right, as tough as it is, and I keep stressing this to a lot of guys, as tough as it is, just sit on your hands. You have to do it because the point of trading is to make money at the end of the year. It's not about making money on a daily basis. It's not about making money on each individual trade. It's not a game. It's not. Oh, I made money. Great. I have this high. Oh, I lost money. I have this low. It's not about that. It's about making a career and living a certain lifestyle that you want. So at the end of the year, you have to look at the overall number. You can't look at individual trades. You have to look at the total number at the end of the year, and you have to make a decision. Is this something that you could do profitably? Is this an environment that's good for these strategies? Do I have to tweak my strategies? Maybe trading is not for me. Maybe this is not the career I want. But you can't look at it on a daily basis or a monthly basis and and just overtrade. That's what kills a trader's P&L. That's what makes a profitable trader negative, what makes a really, really good trader be an okay trader. And if you have the ability to sit on the sidelines, it could even make a strategy that's flawed into a decent strategy because you miss out on the losing times.
Okay, great, Gary. That's super interesting. Can you go a little bit more though into how you use correlations in other assets to make money on the instrument that you're interested in trading?
Yeah, so one of the things that I learned early on is that there's a lot of different ways to make money. Markets are correlated. Sometimes they are correlated in a positive way, meaning they go up, they both go in the same direction. Sometimes they're correlated in a negative way. And that changes based on the time of the market, what the market's focusing on, and so on. And a lot of times, there's better ways to trade or get the profits, to get the results you want by trading it through different ways. So let me give you an example. Last year, I mentioned this earlier in the conversation. Last year, the market was trading with oil. Oil was leading. So the first thing you have to kind of figure out is what's leading the market? What's making the market go up? Is oil leading the ES, or is the ES leading the oil market? So once you come up with that correlation, you could kind of start figuring out, okay, they're correlated in the same direction. So as oil was going down, the ES market was going down with oil at a smaller percentage, a slower pace, but it was the same direction because the concept was that the banks had a lot of oil junk bonds on their books, and if oil kept going down, you would see a lot of bankruptcies. If you see a lot of bankruptcies, then that would affect the banks negatively, which would affect the overall ES or the overall market negatively. So that was the thesis of why oil was leading the market down. But there was also other things going on in the markets that were negative at the beginning of last year, particularly China. People were getting really worried at China. China's growth rate was slowing down pretty quickly. Didn't seem like the Chinese central bank was ready to push stimulus in. Fiscally, they were pushing stimulus in at the time. On top of that, you had the oil concerns that were going to affect emerging markets, even if oil stabilized at those low levels, because that means countries that typically would buy mining equipment, countries that typically would consume, they would have higher unemployment because the oil prices were low, so there would be less jobs, meaning they would buy less U.S. products. So there was all of these things coming together, and just to trade oil, and I was short oil for a long period of time, but at that point, oil was becoming very volatile, and it could move 4 or 5% easily in a few hours either way. And it just wasn't necessarily the best way for me to trade oil because I thought the risk was becoming too high for the actual reward. So what I was doing is I was trading the ES based off of expecting oil to continue to go lower because the technical analysis was telling me oil was heading lower. Oil was trading around 40. I thought it could get into the low 30s and ended up going into the high 20s. But I also didn't put beyond a reasonable doubt that oil could bounce from 40 to 60 in a quick amount of time. So now I decided that the better way to trade it was ES. I looked at the options, unfortunately, because when the market goes down, the volatility index spikes, so the implied vol was too high, so it didn't make sense to trade it with options. So I decided to trade ES outright. I shorted ES, and I ended up making good money because I was right on the direction of oil. I probably would have been done better if I just stayed short oil, but in my opinion, I felt like the risk was much less shorting ES, that a 20-point bounce in oil would have led not to a equally painful bounce in the ES because there's other overlining factors such as China, such as even if oil bounces from 40 to 50, 55, whatever the bounce could have been, it still wouldn't have been necessarily high enough for emerging markets to turn around and stave off a recession. So I felt like ES was a safer play. And these correlations and divergences also exist in the market all the time. One of the ones that's been around for a long time is it kind of went awry last year a bit, but when the yen goes down, versus the dollar, meaning that it becomes weaker, the market benefits from it because a lot of cash comes into the market and vice versa. So when the yen gets stronger, so a lot of times in the past few like 3 4 years, that's what I was trading. So I saw maybe no pattern on the ES, but I saw a pattern on the yen that was telling me, oh, the yen is going to go from 100 to 120, let's say. So a better way to play that than to take a risky bet on the yen was to trade the markets, or vice versa. Sometimes I saw the market wanted to go higher or lower, and I said, you know what, the better way to play that is the yen, because the yen is overextended. I doubt the yen could push any higher at this point, so on and so on. So I'm always looking for these correlations. I'm always looking for a better way to trade the signal that I get. So if I'm getting a longer term swing signal that's telling me the market could go higher, I am trying to figure out exactly the best way to play it. And right now, with the low implied vol, as I said earlier, the best way, in my opinion, to play it is with options. Now, if the VIX was trading at 13, 14, 15, 16 at a higher level, that might have been not the case, and I'd be looking for other divergences or other uh, coincidences in the market to take advantage of that. Maybe I would short the yen, knowing that if the market goes higher, I'll probably take the yen lower. Maybe I would do something with interest rates. But right now, you have an easy correlation, which is the derivative of the ES is so cheap that I like playing it, and I think that there's a lot of opportunity in there. So even though a lot of people are suffering right now and sitting on the sidelines or getting chopped up, there's always opportunities in this market, or usually there's opportunities in this market.
Gary, I really liked what you said earlier. You just said that basically, you might have done better had you continued to short oil, but you felt like the risk was too high, and I think that really resonated with me. I think it resonates with a lot of traders out there. A lot of time they're in a certain trade, and they're like, they get out of it early, and they feel like, yeah, if I had just stayed in it, etc., I could have made more money. But I think ultimately it comes down to looking at a long-term profitable strategy. And when you look at your trading as not just a day trade or just a weekly trade or even a monthly trade, but you look at it in a longer spectrum of over the course of a year, how much are you risking, and at what point do you realize that, hey, this is enough? The risk now is too high. I got to get out of this, and I got to look for something else.
It comes down to what you're risking, how much money, what you're risking is how much money you're risking. And once you take a look at how much money you're risking, you kind of have to take a look at how high do you think the probability of that happening. So if I would have bought ES straight out, and I don't know exactly how many contracts I would have bought because that's not what I ended up doing, but I have a certain number in my mind, and I would have looked back and said, okay, I'm buying it at 2280. I think if it breaks under this level, whatever the level would have been, let's say 2260, I'm going to get stopped out. I want out of the trade. So I would have been risking 20 points. Based on 20 points, I know exactly if I want to risk $30,000 on this position, I know exactly how many contracts I need to take, knowing that. Now, that said, for me to make that trade happen, I need to at least look to make 20 points, right? So if I'm risking 20, in the way that I set up my strategies, it's at least 1-to-1. Sometimes 2-to-1, 3-to-1, 4-to-1, 5-to-1, depending on how many different indicators, which indicator, overall breadth of the market, and so on. I take a look at that and I set up my trades differently. But I almost never, ever, ever take a trade that has a less than 1-to-1 risk reward. So in this case, I would be still in the trade. I would have ended up making less money. I would have had a big unrealized loss when the market was trading in the low 2260s, fearing to be stopped out, maybe 4 or 5 points away from a stop out. And you get unlucky. Sometimes there's a swoosh, you get stopped out. You get stopped out at the low, and then the market turns around back to 2290. So in my opinion, it wasn't the right way you're always looking at the risk, you're always looking at the reward. And the benefits didn't outweigh the risk, the benefits was like, well, if it stays in a range bound scenario for another week or two, I might lose a lot of premiums, and I get that. That does make sense, and I understand traders who fear, the market staying sideways for a week and a half. But that's something that you have to weigh on a personal level. And that takes experience. It takes knowledge of the markets. You have to weigh different scenarios, and you have to say, hey, I'm really confident that the market wants to go higher. I'm really confident the market's not going to stop me out, but I don't want to have this time affecting me. That's why. What I like to do is whenever I'm up, the amount of premium that I have, when I'm up, usually that's 2-to-1, I take it. And you don't have to be in the money to get that, because when you're buying your calls, like I mentioned earlier, I was buying 22.95 at an average price of 20 cents, let's say. Once it goes to 40 cents, I've doubled up on that portion of the money. Now, again, I would have to obviously get out of the entire amount if I wanted to just double up there. So what I do is I let it go a little bit above. I let it go to 3 times. So when it turns into 60 cents, I start slowly taking it off. And because I have different time frames and I have different strike prices, I see which ones I like better. I kind of price them out. I kind of, depending on how much time I have left until expiration, depending on how big the move it was already occurring, take a look at all of these things. I place them into a model, and I come out with an answer of which ones I should sell, how much risk I should leave on the books. And I like to take it off because, like in this case, I had $30,000 worth of premium. If I take off the $30,000 worth of premium, even if I was wrong, so the market turned around for 2287 and ends up under 2280, which was a possibility since the market was so range bound, I at least got my premiums back. Yeah, I lost some money on commissions, which, it sucks. It adds up. But now I have that $30,000 to put into this week Wednesday calls. So I'm kind of always rolling it. So as long as it doesn't go one direction straight down, typically you have an opportunity where if the market goes in your direction just a little bit, you're able to start taking off some premiums to capture back that your initial premium. Now again, you're leaving money on the table, like I did on Friday. I took back my $30,000 premiums, which if I would have kept till the end of the day would have probably been closer to $80,000. So I left $50,000 on the table. But if I was wrong on the timing, now I have that $30,000 to put back into this week's Wednesdays and Fridays calls, and have a couple of extra days to kind of fight again. Now, sometimes they expire totally worthless, and you never had that opportunity. But most of the time, when that happens, I would have probably got stopped out of because I was wrong on the direction. It wasn't that necessarily the market, just stayed in a very small range and never gave me an opportunity. It typically means that, hey, I was just wrong on the direction, and I would have got stopped out even if I would have bought the calls regardless.
Gary, thanks so much for your time. Very interesting information here. We'll stay tuned. And as always, Size Traders, subscribe, Size Trade Bulls, Bears, and Pigs. This is our podcast. Until next time, Gary, we'll keep in touch. Thanks so much.
Thanks a lot, Amos. Have a good one.